I think gold's going to continue its uptrend. I mean, it's been trending up, since the beginning of the century or the millennium. It's been outperforming stocks over that time period. We have pulled back. I mean, right now we're around 2,630 or so, 2,620. At our peak before the election, gold almost hit $2,800 an ounce. Didn't quite get there. But peak to trough, gold pulled back about 7%, which is not, that big considering how much it had gone up. It was up well over 30% on the year. The big decline was in the mining stocks, which actually turned negative on the year. I mean, most mining stocks are now down on the year, even though gold itself is up around 26, 27% year to date. So I think that that shows you where the money is going to be made in the years ahead. It's going to be made by the people who go against the crowd and buy the gold.
In a remarkable display of market strength, gold has emerged as a standout performer in 2024, rising 28% through November. Prices are around $2,611 after nearing $2,800. This strong performance has attracted attention, particularly from economist Peter Schiff, who has long been bearish on traditional markets and supportive of gold investment. Peter Schiff emphasizes that gold has demonstrated superior performance to stocks since 2000. His analysis points to recent market consolidation, with gold prices settling in the $2,600 to $2,630 range after approaching $2,800 before the election. The price movements remain stable at around $2,611 as markets digest the current outlook on U.S. interest rates. The U.S. dollar's strength persists, bolstered by expectations that the Federal Reserve will adopt a more measured approach to rate cuts. Projections indicate a federal funds rate of 3.9% by the end of 2025. Despite gold already achieving record highs and approaching $2,800 per ounce, market sentiment remains bullish. Multiple analysts project potential gains extending to $3,000 per ounce before year's end. Peter Schiff points out a market anomaly. Despite gold surging nearly 30% in 2024, major gold mining companies like Newmont and Barrick have seen their stocks fall about 35%, 7 times gold's 7% correction. The exceptional performance in the gold market has been sustained by robust central bank purchasing and steady investor demand, which has compensated for softer consumer buying patterns. Asian investors have maintained active market participation, while reduced yields and a weakening U.S. dollar during the third quarter have stimulated Western investment interest. Looking ahead to 2025, market consensus regarding GDP yields and inflation suggests continued growth for gold, albeit at a more moderate pace. Before we dive deep into this video, please subscribe to our channel, hit the bell icon so you never miss an update, and share it with friends who may benefit from it.
I think gold's going to continue its uptrend. I mean, it's been trending up, since the beginning of the century or the millennium. It's been outperforming stocks over that time period. I expect that to continue for all the reasons that the trend is there. We have pulled back. I mean, right now we're around 2,630 or so, 2,620. At our peak before the election, gold almost hit $2,800 an ounce. Didn't quite get there. But peak to trough, gold pulled back about 7%, which is not that big considering how much it had gone up. It was up well over 30% on the year. The big decline was in the mining stocks, which actually turned negative on the year. I mean, most mining stocks are now down on the year, even though gold itself is up around 26, 27% year to date. The gold stocks are down. I mean, from their peaks, the big gold stocks fell about 35%, with gold down 7%. So that's 7 times the decline, which is ridiculous. And big companies like Newmont and Barrick are negative on the year. They're down in 2024, even though gold is up close to 30% during this year. And so that just shows you how negative the sentiment is on gold, that people aren't willing to buy these stocks, that they're trading for less than 12 times earnings with a market multiple, PE of more than double that. So you've got all kinds of crazy enthusiasm for tech stocks and cryptocurrencies, and really irrational pessimism regarding gold. So I think that that shows you where the money is going to be made in the years ahead. It's going to be made by the people who go against the crowd and buy the gold, and more importantly, buy gold mining stocks, and people who sell these overpriced tech stocks and basically worthless cryptocurrencies, which would include Bitcoin. The Dow was up about 400 points at its peak yesterday, but it gave up, all those gains. And for now, as of right now, the Dow is rallying today. But I don't think the market's out of the woods, because I think it was a real eye-opener, what the Fed said, I think, for a lot of people. And I think yesterday, even though the Fed cut rates, it really tightened monetary policy. It let people know that fewer rate cuts are coming, and they may not even come at all. We may have to hike rates. because not only is inflation higher than we expected it to be, but it's actually heading in the wrong direction. And that's something I've been talking about all year, as everybody's been talking about how, we're on this glide path to 2%. I've been pointing out that I don't think we're going to hit 2% because we've kind of run into an impasse around 3%. And that's where we've been building a base. So I think next year, you're going to see much higher inflation numbers. But I also think we're going to have much weaker economic numbers. So I think it's going to be stagflation, which is the one thing, Powell was asked at a press conference, what's the Fed's plans for stagflation? And he kind of laughed and he said, well, our plan is we just hope we don't have it, because they don't really have a plan. So all they can do is hope that they don't get the one thing that they're not prepared for. But, Murphy has a law, anything that can go wrong will. And we're going to have stagflation, despite the fact that the Fed is hoping to avoid it.
Peter Schiff predicts stagflation in the U.S., warning that the Federal Reserve's return to quantitative easing will lead to a weaker economy and rising inflation, a scenario markets are not ready for. He also expects a sharp dollar decline and a significant inflation surge. However, current economic indicators paint a different picture from the stagflation experienced in previous decades. The U.S. economy has shown resilience, with projections indicating annual growth exceeding 2% in 2024. Additionally, inflation has demonstrated a marked decline over the past 2 years, currently hovering just above the Federal Reserve's 2% target. The specter of stagflation brings back memories of 1981, when the U.S. last experienced comparable inflation levels. During that period, escalating prices and economic weakness created widespread financial difficulties for American households. Central bankers faced a challenging policy dilemma. Raising interest rates to combat inflation risked pushing the already weak economy into recession. Lowering rates to stimulate economic activity could further fuel inflation. Let's get back to the interview.
I think we are going to stagflation, and I think the Fed is going to go back to quantitative easing, but I think this is going to be happening with higher inflation. So we're going to get higher inflation and a weaker economy simultaneously, which is something that the markets are not prepared for. And so I think that really could be a wake-up call. The dollar could really start to drop, inflation could really accelerate, gold go through the roof, and we could have a day of reckoning. I'm just following the same plan that I've had. It's been a rough road because they keep kicking the can down that road, and so extending that day of reckoning into the future. But I'm confident that I've got it right as far as what's going to happen, even if it's taken longer than I thought before it happens. But I continue to own the gold, silver, the miners, resources, foreign stocks, emerging markets. I continue to be out of the US dollar, even though, on paper, as of right now, those have not been the winning trades. The best trades have been long US stocks, particularly long tech stocks, the Magnificent Seven, long AI, long crypto, long Bitcoin. I think ultimately the people who are in those positions, if they don't get out of them, which most people by definition can't, and so they're going to end up with huge losses at the end of the day. And I think that I'm going to end up with big gains, even though it's going to take longer to get there. It's like the hare and the tortoise, right? The Bitcoin crowd has got a big lead right now, but at the end of the day, I think I'm going to cross the finish line, and they're going to die of exhaustion or whatever, but they're not going to make it. Well, it depends. If the dollar crashes too, then you'll have gold going up. But if we have a real crash, probably everything's going to go down. But the question is, how long will it stay down? Because the way the Fed reacts to a crash is prints a lot more money. And so I don't know that we're going to have a 1987 style crash, right, where the market drops 20% in one day. I mean, we were down 1,100 points yesterday on the Dow, but that's only 2.5%. That the biggest loser was the Russell 2000 was down 4%, right? We don't, these are not crashes, like a 1929 or 1987. We may get one because the market is more overvalued now than it was, in 1929 or 1987. So, we're vulnerable for a crash, but we may not get one because of the dynamics of the central banks and the Fed in particular as to what they do to mitigate a crash. But what they do is just create inflation. So it's not like, we get it for nothing.
The outlook for gold suggests it will remain a critical asset amid economic uncertainties. With expectations of a weakening economy, rising inflation, and potential declines in the dollar, gold's value may continue to strengthen. Investors and central banks have already demonstrated confidence in gold's stability. As macroeconomic challenges persist, it will likely maintain its appeal as a hedge against inflation and market volatility. What are your thoughts on the future of gold? Let us know in the comments below. If you found this video helpful, don't forget to hit the like button and subscribe for more updates on the latest economic insights. Thanks for watching.